From the 1820s, new technologies for transport and growth in income from the Industrial Revolution powered a new phase of expansion in trade and migration between countries. This era is known as the first era of globalisation. The first era of globalisation was marvelled at in the industrialised countries of the world. So John Maynard Keynes, for example, said, "The inhabitant of London could order by telephone, sipping his morning tea in bed, the various products of the whole earth in such quantity as he might see fit, and reasonably expect their early delivery upon his doorstep. He could at the same moment and by the same means adventure his wealth in the natural resources and new enterprises of the world, and share without exertion or even trouble in their prospective fruits and advantages." So in countries like Britain, the reach of trade, the reach of investment, the scale of migration was seen as heralding a new era. But as is often the case with economic development, this was a two-edged sword. And that this period, the first year of globalisation, also saw a large increase in the colonial or imperialist enterprise from Europe. European nations imposed economic and political subjugation on countries in other parts of the world, generally using violence as the means of achieving that subjugation. India wasn't the place where the most violence occurred as part of this colonial enterprise, but there were major episodes of violence, such as the 1857 mutiny of Muslim soldiers against their British overlords. And here I've got a picture of the execution of some of the Indian soldiers after the revolt was put down by the British. And Neil Ferguson says in his book Empire of the Violent Response by the British that the route of the British retaliation could be followed by the scores of corpses they left hanging from trees along the line of their march. J.G. Farrell, in his novel about this mutiny, The Siege of Krishnapur, has one of his main characters, the collector, who has been involved in the mutiny, now at the time of writing back in Britain, say perhaps by the very end of his life in 1880, he had come to believe that a people, a nation, does not create itself according to its own best ideas, but is shaped by other forces of which it has little knowledge. So it's important to keep in mind these two sort of perspectives as we talk about this era of globalisation. Basically, what happened during this era of globalisation was there was a massive expansion in the extent of connectedness between countries in the world, or at least between sort of a group of countries in the world. This happened through an expansion in the extent of trade in goods and services. It happened through increased immigration, labour flows, and it happened through increased international capital flows. So if we think about trade in goods and services, from 1820 to World War I, the percentage of imports and exports in the world as a share of world GDP increased from 2% to 20%, or on some accounts even more than 20%. In this table I've just got some data on exports as a share of world GDP, and it shows a similar sort of story, that from 1820 to 1913 there's about a 9 or 10-fold increase in the extent of trade adjusted for the size of the world economy. So trade was taking into account the size of the world economy 9 or 10 times as big by World War I as it had been in 1820, 100 years before. If we look at migration and we focus on European migration, so in this period from 1820 to World War I, there were 40 million people who went from Europe to other parts of the world. You can see predominantly they came from the British Isles, Italy and Germany, and very largely they went to the United States, so over 60% going to the United States. but you can also see Argentina, Australasia, which is Australia and New Zealand, and Canada and Brazil were also the major destinations. One distinctive feature of migration, or the movement of population during this period, was that it was predominantly free migrants who were going from Europe to the countries like America and Argentina. So in this period from 1820 to 1880, you can see that slavery still existed. 14% of migration during this period to the Americas was slaves, but predominantly it was Europeans, and predominantly they were free. Whereas, as we've talked about previously, in the period before 1820, in the period after Columbus's voyage to the Americas, most of the movement of population to the Americas was slaves, 3/4 sort of during that period. And while a lot of the migrants who moved were also free, a lot of the non-slave migrants who moved were free, they were in that period a much smaller amount of the population. So this first year of globalisation really marks a change in the type of labour movement to the Americas, in that it's the period where there's the transition from slave-based population of the Americas to European-based population of the Americas. The third element of the first year of globalisation was increased capital flows. And so this graph shows the increase in the period sort of up to World War I in gross investment as a share of GDP. So this is gross foreign investment. So this is the amount that countries are investing in other countries. And you can see that back in the 1870s, the top line sort of all these countries, UK, France, Netherlands, Germany, United States, only about 6%. But in the early 20th century, that's tripled to be about 18 or 19%. Then you can see amongst these countries, sort of the big one is the United Kingdom, which was sort of supplying about half of the total amount of foreign investment during that period. You can take a snapshot of sort of capital flows in 1914. So like the last chart showed us, Britain sort of is the big investing region. France, Germany, also important. The new bit of information in this graph is the recipient region. So you can see, a reasonable amount of this investment was European countries investing in other European countries, about 1/4, but also 1/4 is going to North America, about 20% is going to Latin America, and about sort of 30% is going to Asia, Africa, and Oceania. You can also get a bit of a sense of how investment evolved over time, focusing on British foreign investment. You can see back in 1830 that most of the British investment was within Europe and a little bit to Latin America, but by the time we get to the end of this period, Europe's become relatively unimportant as a source of foreign investment for the British, and it's the United States and other colonies which are now more important. So during this period, the nature of foreign investment in places like Britain changed, increasingly going towards United States and other British colonies. Why did this phase of increased connectedness between countries in the world happen? Why did the first year of globalisation happen? Well, in this graph, I've tried to organise the sort of potential explanatory factors which are usually identified into 3 categories. The first is the cost of distance. So that's the cost of, say, shipping goods from one country to another, the cost of transmitting information about financial markets, for example, from one country to another. And the idea here is that the lower the cost of distance are, the more contact we'd expect there to be. So if it's cheaper to ship wheat from the United States to England, so it's lowering the transactions cost of selling, then we'd expect more of that trade to occur. The second factor is government policy. And government policy is really about the extent to which government imposes restrictions on the degree of connectedness. And so that could occur by imposing restrictions on the amount of trade in goods and services, for example, tariffs. It could involve the extent of restriction that's imposed on immigration flows, for example, whether there are immigrants from some countries who are ruled as not legally being able to migrate to a country, or whether, on the other hand, a government might be providing support, subsidies to people to migrate to a country. And then international capital flows, essentially whether the government's imposed restrictions on inflows and outflows of international capital. The third group of factors identified is what I call underlying conditions, and that's things like extent of comparative advantage, inter-country wage differences, population size and income level. So, for example, the bigger the inter-country wage difference there is between two countries, the greater the incentive we'd think there would be for population to migrate from the low wage country to the high wage country. Extent of comparative advantage, there the idea is that the greater the difference in the degree of comparative advantage, or the relative opportunity cost of producing in two countries, the more the incentives are for specialisation in production activities in which you have the comparative advantage, and so the more likely it is then that you're going to want to trade on the basis of that specialisation in production. So those are the three categories of factors that we could potentially think of as driving greater connectedness between countries in this first era of globalisation. And what I want to do now is sort of talk a little bit about each of those factors. So it seems undoubtedly the case that decreases in the cost of distance during the first year of globalisation were a major factor explaining why the first year of globalisation occurs. And you can think of those costs of distance in three ways. First of all, there were internal costs of distance, so cost of transport within a country. Cost of transport within a country were decreased primarily by the introduction of railways and by more extensive canal systems. So this graph, for example, shows the rapid expansion in the miles of railways in countries like the United Kingdom, the United States, France, Germany, Russia, during India as well, during this period. So railways lowered the cost of transporting products within a country, and often that fed into making it less expensive to trade internationally. If you could bring, for example, grain from where it was being produced in the middle of the United States to ports on the east coast of America more cheaply, that meant that you were lowering the cost at which you could sell it to grain markets in Europe. There were also important developments in canal systems in Britain, but also especially in the United States. So this quote from Kevin O'Rourke and Jeff Williamson makes the point that British navigable waterways quadrupled between 1750 and 1820 and were 50 to 75% cheaper to use than roads. In the United States, construction of the Erie Canal between 1817 and 1825 reduced the cost of transport between Buffalo and New York City by 85%. So reducing the cost of taking agricultural products to New York from where it could be shipped, for example, to Europe, and cut the time of the journey as well. So a lower opportunity cost in terms of the economic activity of transport as well. It took 52 days to ship a load of freight from Cincinnati to New York City by wagon and riverboat in 1817, but only 6 days in 1852. So basically, internal costs of distance were massively reduced during this period by railways and by canals. Secondly, there's the international cost of distance. And the international cost of distance was reduced during this period by several factors. First of all, there were improvements to sailing ship technology. There was improvements in the development of steamships. So steamships didn't replace sailing ships overnight. There were various engineering problems to do with things like steel hulls and developing paddles that meant that it was sort of really in the latter part of this first era of globalisation that steamships took over. In 1860, William Bernstein's calculated that for any journeys less than 3,000 miles, it was better to do it by, any journeys more than 3,000 miles, it was better to do it by sail than by steam. But by 1890, basically any journey less than 10,000 miles, you were better off doing by steam. It was less expensive to do by steam. Second major development was the opening of the Suez Canal. The Suez Canal cut the distance from London to Bombay from 11,500 to 6,200 miles. So basically a halving of the distance that shipping had to travel to get from, for example, London to Asia. And so that was a massive reduction in the cost of transport from Western Europe to Asian markets. The other major development for international transport was refrigeration. So refrigeration created the scope to transport types of products such as raw meat, slaughtered meat, which hadn't been able to be transported before. There had been early attempts at refrigeration by packing meat in ice, but it really only develops on a large-scale basis with the development of refrigeration using principles of thermodynamics, initially sort of to transport meat within the United States from Chicago to other parts of the United States, but then by the 1890s being used on refrigerated steamboats to ship chilled and refrigerated beef from the United States, Argentina, New Zealand, and eventually Australia to European markets. Now, here's one perspective on the decrease in cost of ocean shipping, showing that with an index which is equal to 100 in 1900, showing that in 1790 the cost of ocean shipping sort of averaged across all different routes, and that was about 3.5 times what it would eventually be in 1900, and it would fall a little bit more to 1913. So, a fall of a factor of about 3.5. As another example, the cost of a passage between London and America across the Atlantic basically was reduced by a factor of 5 during this period of the first year of globalisation. So there were major decreases in the cost of international transport during this period. The other element of the cost of distance was the cost of transmitting information, and this was reduced significantly during this period with the development of the telegraph. So in 1844, Samuel Morse has constructed a telegraph that runs from Washington DC to Baltimore, and quickly comes to prominence, feeding results from the National Democratic Convention, which was being held in Baltimore, back to Washington. The Gagniani messenger in France hails this as a triumph, calling it the annihilation of space. And in 1851, there's a telegraph cable crossing the English Channel. In 1865, there's a telegraph crossing the Atlantic from North America to Europe. So this, for example, gives the basis for much stronger links between financial markets. It means that you can get information more quickly on what's happening in American financial markets in Britain, and raises the level of the ability to invest, feeling that you're well informed about what's happening in those markets. The second factor, where there's sort of perhaps a relatively mixed influence on the globalisation that occurs, is policy. There are 3 elements of policy: international trade, protection, immigration restrictions, and limits on capital flows. And I'll deal with those in turn. With protection, there's a mixed story. First of all, dealing with Europe. In Europe, in the period up to 1870, it seems that protection was largely reduced. This involved things like the repeal of the Corn Law in Britain, the Cobden Chevalier Anglo-French trade treaty. But after 1870, rates of protection are steady or tend to increase. Protection in Europe in this period is mainly protection on agricultural products, protection against agricultural imports, because that was the main type of import competition to Europe. In the New World, for example, in the United States, there the protection is mainly on manufactured products, because manufactured products were the main products that were competing with imports being produced in the United States. And there the story is that there was relatively high rates of protection that were maintained sort of in a relatively similar way during the period of the first era of globalisation. This is a table that gives you some data on manufactured products. You can see the point about the United States having relatively high levels of tariffs on manufactured goods. I've also included some data here for Europe. As I said, the main relevant tariffs in Europe during this period were on agricultural products, but you can see that sort of there's a similar kind of pattern to what I described for agricultural products, of a tendency for protection rates to fall a little bit from 1820 to 1875, but then in some cases to increase sort of in the period after the 1870s. Second aspect was immigration policy. Now, the main countries which were receiving immigrants from Europe, which we saw before, United States, Canada, Australasia, Argentina, all have a similar experience, which is that up until the 1860s or 1870s, immigration remains relatively unrestricted. But after the 1870s, the countries impose increasing restrictions on immigration. And this is shown for the example of the US in this graph. This is an index by Ashley Timmer and Jeff Williamson where they've coded immigration policy in the United States. And +5 would mean that it was very open, -5 means relatively closed. And you can see sort of in the 1860s and 1870s it's relatively neutral, but through the period then from the late 19th and early 20th century, immigration policy becomes relatively more restrictive. And that was a pattern that occurred in the other most of the other economies to which migration was going as well, Argentina perhaps being the exception. The other thing that happened in terms of policy was, which I'll address in the next section of this lecture in more detail, was an increasing number of countries moving on to what was called the gold standard. And the way to think of the gold standard was that as a mechanism that lowered the transactions costs for countries of trading with each other, because it created a fixed rate of exchange between them. It made it easier to trade because countries knew how much it was going to cost each other to trade. The third factor which drove globalisation during this period was the growth in income and the growth in world population size that occurred. So, for example, the growth in income meant there was a larger market for buying consumption goods. The growth in technological development in Europe ahead of other parts of the world meant that there was an increasing divergence in comparative advantage, which meant there was more specialisation in production, which again created more scope for trade. The income gaps that increasingly emerged between the old world countries in Europe and other parts of the world created increased incentives for migration. So this expansion in income levels, the divergence in income, the divergence in technologies was an important factor in driving global increases in trade and migration. One way of summarising the influence of these different variables is through trying to decompose the effect of decompose the total change in an outcome like the ratio of trade to GDP into the different individual factors that cause that change. And so I've taken this table from a study by Alan Taylor and some co-authors where they tried to do that. They said, okay, look, what was the relative influence of the different potential causal factors on the increase in the ratio of trade to GDP that we know that occurred in the world from 1870 to 1913. And they basically estimate that about 30% of it was due to decrease in transport costs. A large proportion of it was due to the gold standard, so countries having lower costs of trading with each other through the gold standard. And also, the other large factor driving it was this income convergence, the growth in incomes around the growth in incomes globally, driving increasing international trade in the kinds of way I suggested. So that's been something about what happened and why. In the next part of this section of the lecture, I'll go on to talk about the consequences of this first year of globalisation.